Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 180, 15th of February 2022. And today we're going to discuss something called the prospect theory. How gains are giving us less pleasure, and the pain of a loss is much more, even if they are on the absolute comparable basis. So we'll see that with several examples as we go along. In terms of the markets today, markets came back with a vengeance after having dramatically dropped yesterday on the Ukraine news, and today, of course, there was some rumors or some news item that some troops are getting pulled back and the markets have bounced again. So, I mean, largely, what if you will take a step back and see that all these moves are essentially just markets keeping themselves in tandem with other markets, mainly the mother market, the US market. Otherwise, Ukraine was in a situation has been in a situation for a long time. Crude oil has been rising for last many months, and yesterday was not really such a disaster that we should have dropped as much on a sudden note. But it's just that market takes cognizance of such potential events only on a certain day, and it all precipitates down then. And today the reverse has happened. For now, at least, the market is kind of suggesting that that fear has gone away. Gold had gone up yesterday dramatically. Today it has corrected a bit. So it is all a risk of trade that has taken place yesterday, and today again risk on has happened, with money again flowing towards emerging markets possibly. So autos, PSU banks, private banks, consumption stocks, infra, IT, you name it, all sectors were up 2 to 3, 4% today, with pharma and public sector enterprises being the lowest gainers. So a lot of the damage of yesterday has been recovered, not fully though, but a lot of the part of the damage got recovered today. Again, on the indices, Nifty ended up 3%, Nifty 50 ended up, next 50 ended up 2.5%, CNX 500 2.8%, small caps 2%, mid cap and small caps 2.4%. So reasonably, pretty much in line with 2 to 3% kind of gains. And the weekend investing small case is also gaining similarly, but still not yet covering up yesterday's losses, with gains from between 1.5% to 3% on various strategies. So let's go to the topic of the day, the prospect theory. What are we trying to say here? Let's take an example. So if you had a choice or given a chance that there's a 100% chance that you get 1,000 rupees versus there's a 50% chance that you may get 2,000 rupees or a 50% chance that you may get zero. Suppose that these two options are presented to you. Which one do you choose? What is the sort of logic that prevails in your mind, which tells you, whether I should go for a guaranteed 1,000 rupees or should I take a chance and take 2,000 rupees? There is a chance also that I may not get anything. So which one would you choose? Most people will choose option 1 with a guaranteed amount of 1,000 rupees, regardless of what was the prospect in the other option. This may have been even 20,000 rupees, but still it may have been a choice of getting a guaranteed return for many people. Another interesting scenario could be, let's say you had a choice that you're guaranteed 1,000 rupees on each trade and you're doing 10 trades. Versus option B, where you're doing 10 trades, in which 50% of the trades, so in 5 trades you'll get 4,000. In the rest 5 trades you'll lose 1,500. Now which one will you pick? Those who will do the math will find that option B is resulting in more money, will choose option B. But intuitively, if you did not do the math and choose this, intuitively you'll still stay with option A. Somehow option A, with the word guaranteed and the smoothness of the returns there, is giving us some sort of peace, if you may say, or some confidence that that there is no red in my trade sheet. So while option gives you more profits, this would have been 12,500, this would have been 10,000 rupees, but still many would choose option A. Now why is this happening? So this is what prospect theory is all about. That if you were to see what is your psychological impact if you lose money. So you attribute the losses to being hurt more than the pleasure of winning. So losing $100 here gives you more pain than gaining $100, which gives you less of pleasure or value, as you may call it. So this is how the brain is wired. We lose 10 rupees, we feel a pain, but we gain 10 rupees, we don't feel an equivalent amount of positive feedback in the brain that we had as per the negative feedback. So if you lose $1 lakh rupees, you are deeply hurt. If you win $1 lakh rupees, you are positive, you are happy, you are you filled with pleasure, but not to the same absolute level of pleasure or pain that you would have had you lost $1 lakh rupees. So that's what this is all driving towards. This is the prospect theory, where the pain of losing 1,000 is much more than the pleasure of gaining the same 1,000. So that's why if like we saw Nifty drop yesterday, and if in case your strategy had gained the same amount of the loss from yesterday, the pain yesterday was immense, but that pleasure of coming back to the same point is not so much in the absolute terms, and it's human. I mean, this is how we are wired. So losses tend to cause a greater emotional impact than equivalent gain. So what are we trying to drive here is that because we are wired this way, and most people are, some people may not be, I mean there are always exceptions, but because most people are wired this way, you want to reduce pain in your journey. So if you want to reduce pain, you should not be taking equivalent amount of losses as your gains. The losses have to be much smaller than your gains to sort of match the level of pain and gain that you are experiencing on the way. Otherwise, what will happen is that you will have excruciating pain, but only a little bit of pleasure when things go right, and that's not really balanced. I mean, you'll always remain, a bit of a sort of a negative energy person if that is happening. Also, people have very strong preference for certainty. I mean, that's why people want to take insurance, for instance, or people want to prepay on things, because as our brain is wired to sort of like conformity and certainty. So if we have a decided path and we know that this is going to happen, then we want to go that way and not take a detour where we may gain more. So we are equipped to take lesser profits if that helps them avoid the pain of having to go through the losses. So again, the preference is or certainty of gain, even if it is smaller than the alternative. Then a lot of us are also interested in what is our relative gain versus others. So regardless of where we are reaching, if like the example on Twitter that I said, that Ram bought a stock worth 100 and it moved to 120. Whereas Sham bought a stock worth 100, it moved to 200 and then it came back to 180. So Ram is still very happy, very positive. Sham has seen 200 and it's come back to 80, is kind of very, very deeply hurt. Although both have started at the same point and both have ended at the same point. So the journey also matters, and we are looking at somebody else's gains or losses also to sort of classify our own, and that is generating the cause of happiness or sadness in our mind. So that is also something that one needs to take care of. And the last point, which is very, very important, is that people tend to underreact to low probability events. So we see a lot of transactions happening, let's say in option selling, without any risk management. Those who are doing option selling without risk management overnight and fully leveraged, they may have backtested their strategies so many years, and that kind of a Six Sigma event may not have happened in those years. It may happen tomorrow. Your entire capital may get wiped out tomorrow if you are not careful about what is that low probability event that can happen. So you may completely discount the probability of losing your wealth if that probability of event is very small, or you may not have factored in that unknown that is always possible. So you may be taking very high risk decisions because you have not factored that very, very low probability event. And it can happen to any strategy, anybody. I mean, even if it is a risk managed strategy, let's say I've sold some options and I have a cover above, let's say 30% above. The market may suddenly, have some turbulence. The systems may go down. All the orders may get cancelled, and the next time the market opens, it may open at a circuit against you. So with all the precautions that you have, you can still lose. So there are some very, very low probability events that can always happen, regardless of however much care you take, and hence that is also to be factored into your calculation. So this is what prospect theory is all about. So my sense of telling you more about all this is, as I've been always saying, that we must try to reduce our pain points, because there is no point living in pain for 80% of our journey and not having that pleasure on the other side. Rather, we should have pleasureful days and pleasureful positive energy in our mind for 80% of the days, and some pain, because some pain is associated with the kind of work that we are doing. So with this sort of discussion, I hope you will relook into how you are managing your gain and pain, and sort of change it towards more gain with less pain, and that will really help you in your journey. So thank you so much for watching this, and I'll see you in another video. Bye.